Global markets were hit with a series of shocks last year, including inflation, slow economic growth, a banking crisis in the US and Europe, and the continued tightening of interest rates. So what's in store for 2024? I caught up with Julia Lee, investment strategist at State Street Global Advisors, a little earlier, and started by asking her what we can expect to see this earnings season.
I think there are a few levers to be looking at for the Australian share market this year, but for investors, one of the key ones is always earnings. And if you compare earnings expectations for Australia compared to the rest of the world, it is looking a touch soft. So if we have a look at what the market is expecting for earnings, it is expecting that earnings will go backwards just slightly by 3.3%. But then, you compare that with the rest of the globe, where in Japan, we're still seeing more upgrades and downgrades to firms. And of course, in the US, where about an 11% growth rate is expected for earnings. And that really tells you why the performance may have been soft. So here in Australia, in the year to date so far, we're down a touch, down by about 1%. That compares to the US, which is up 2%, and Japan, which is absolutely blowing the lights out with a gain of more than 8% in 2024 so far.
Yeah, S&P 500's basically hit a record high. Now, is a lot of that not just earnings season, but the speculation that the Fed's probably going to be cutting interest rates a few times this year?
I guess if you have a look at what's driving the market, there are three key levers. As you mentioned, interest rates is a key one, and that's been driving the market for a while, and a big reason why we did see that late rally in 2023. The second one is earnings, and if you have a look at the earnings picture, the most optimistic area in terms of earnings, quite similar to last year, where the best earnings came from the tech and the tech-related sectors. So that includes information technology, consumer discretionary, as well as looking at the communication services area. And if you look at how those three areas performed in terms of the US last year, information technology together with consumer discretionary and communications all up more than 40%, and of course the US stock market up more than 24% last year. If we have a look at earnings, given that they were a key driver last year, the good news is that we're still seeing upgrades to those tech and tech-related stocks, so that bodes well for performance this year.
Yeah, NASDAQ back in a bull market. Artificial intelligence stocks still seem to have a lot of upside.
Yeah, artificial intelligence, I guess when you have a look at the market and look at trends, you can have a look at things on a cyclical basis. These are things that move together with the economic cycle. Now, cyclical areas are a little bit difficult at the moment because we're heading into an environment where we are likely to see slower growth. Those rate hikes that we saw last year are really going to start biting into margins and companies' profitability this year. However, you can also look at structural changes, and these are changes that take place over decades. So if you have a look at the cyclical picture, usually technology, it's a hard place to be when the economy starts to turn downwards because of financing, borrowing costs, as well as the economic environment. But that structural trend of artificial intelligence is really boosting earnings as well as profitability, and that's helping returns in that space.
Now, another global theme this year seems to be geopolitical risk. We've got a situation right now where there's shipping lanes clogged up around the Suez Canal. Are those possibilities to add more to inflation in the economy, events like that?
We have seen geopolitical risk, and especially when there are hiccups in terms of shipping and freight, not really helping with lowering the inflation picture. However, if we have a look at the outlook for the energy sector, which is one of the key areas that's usually disrupted by something like that, the energy sector is expected to see a decrease in terms of earnings this year. So watching that geopolitical space, and of course, also just watching China as well. It's such a large trading partner of Australia, and a key reason why Australia's underperformed because of that exposure to resources and the pressure in terms of some of those commodity prices. So overnight, we did see China cutting its reserve requirement ratio by 50 basis points. So really looking to stimulate that economy, which hopefully means an easier ride for some of our resource companies this year.
Yeah, China's economic growth about 5.2% last year, one of the weakest years since 1990. So yeah, that Aussie resources sector, there are some pockets that seem to be in a bit of trouble with lithium and nickel, but the iron ore space, is that still pretty positive for the next 12 months?
Yeah, I think iron ore is a fascinating space because if you have a look at what iron ore is used for, it's used in steel production. And the demand for steel production primarily comes from building things, especially residential property as well as infrastructure. So we know residential property in China is a really difficult area at the moment. So while we do still continue to expect China to stimulate, just watching that property space because that is a key driver of iron ore demand. Having said that, last year was a record in terms of volumes for Australian iron ore miners. Hopefully that's going to at least remain steady, if not increase a little bit. But in terms of pricing, we really need stability returning to that China property space.
And also looking at Aussie equities, the banking sector, there are some analysts that think some bank stocks could be a little overvalued, but are you positive on the banks for this year?
They call, being negative on the Australian banks the widowmaker. There are a number of people who have been negative on the banks for a number of decades, and it's been difficult to bet against the Aussie banks. I guess the key driver of Australian banks is the Australian property space. And if we have a look at property prices, once again, pretty much at record highs, I think, for the median price, if not close to those record highs. So banks at the moment looking relatively good, of course, going into an economic slowdown. One of the things that you do want to look at is the number of defaults happening. But at the moment, we're seeing still a relatively small number of defaults. And of course, when you do look at more volatile times, one of the things that investors do seek out is a higher dividend. And certainly the banking space as well as the resource space have those higher dividend yields on the Australian market.
Julia Lee from State Street Global Advisors, thanks so much for coming on the show.
Thanks, Ed.